Today, Bitcoin starts the week in the red. Michael Saylor says Ethereum should be treated like a security. And we track down what caused the collapse of firms like Terra and Three Arrows Capital. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Digital currencies are starting the week in the red. By noon Eastern, Bitcoin traded at around $20,000. Ethereum traded around $1,100. Polygon, meanwhile, actually rose to 58 cents. All right, let's catch you up on stories you should know. First, an international finance watchdog is getting ready to propose new crypto regulations. The Financial Stability Board, or FSB, monitors the global financial system and recommends regulations to support it. Well, the FSB just turned its attention to crypto. The organization said it would recommend new regulations for stablecoins and other cryptocurrencies by October. Now, the FSB can't implement these regulations itself, but the 68 countries and authorities from around the world which make up the FSB can. Next, Michael Saylor says that Ethereum shouldn't be treated like a commodity. MicroStrategy's CEO said Ethereum's continued upgrades and forks make it a security. Now, Saylor has said before that the majority of cryptocurrencies should be treated like stocks and bonds, while Bitcoin should be treated like a commodity, such as gold and oil. SEC Chair Gary Gensler actually said the same thing back in June, but a bill in Congress right now would treat most cryptocurrencies like commodities. Finally, multiple projects that operated on the Terra platform are now moving to Polygon. Ryan Wyatt, the CEO of Polygon Studios, tweeted that more than 48 projects had made the migration to the Polygon platform, including NFT marketplaces and play-to-earn games. Now, this follows a major push by Polygon and other networks to draw projects to make the switch after Terra's collapse in May. Okay, for our main story of the day, I spoke to Nik Bhatia, a professor at USC, about what brought about the collapse of Terra and Three Arrows Capital. I also asked him about when we'll come out of this crypto winter. So Nick, it feels like the crypto market meltdown has been a domino effect where one failure begets the next. Where did it all start?
Well, we can trace back this meltdown really to the end of 2021 when the Fed started raising rates. So we saw that inflation was basically running out of control towards the end of 2021, and we see the Fed basically starting to commit to their hiking cycle, and an aggressive one. So from the end of 2021 to a few weeks ago, we had an over 200 basis point move across the Treasury yield curve, including 10s going from 1.5 to 3.5. And when that happens, when tightening comes into any market, you see the most risky investments really start to crumble first. So we saw that crypto prices generally started to come down as the Fed started to commit to their hikes. But really, it all comes down to this collapse of Terra Luna. And that's what really kicked off this whole saga.
Okay, so we've got this domino effect. It starts with this UST stablecoin implosion, and then that hits the crypto hedge fund, Three Arrows Capital, and then from there, it seems like every other day, another company is saying that they have exposure to 3AC. They're in the midst of a solvency crisis, and so what happens next? Like, how many more dominoes are left to fall?
So yes, there is a lot of exposure from the 3AC collapse in that lenders were lending to 3AC, and 3AC not only defaulted on those loans, but now during the liquidation process, we're hearing about the fact that the founders cannot be found, and we're looking at a situation that it wasn't just over leverage, but there were maybe some bad actors in there as well. So we have the collapse of 3AC, we have the collapse of lenders that were exposed to 3AC, but we also have something like Celsius, which the collapse of Celsius, or the bankruptcy proceedings that we will see with Celsius, that is not directly tied to the collapse of 3AC. Rather, we had this drawdown in all of crypto. We had this really blow up in DeFi. Decentralized finance was supposed to be this area where people could borrow and lend in a decentralized way. But when, the critics of UST, for example, were saying, where is this yield coming from? And really, we see that there were Ponzi type characteristics at Celsius where they were attracting depositors with higher yields. just so they could pay down the yield that they had promised their existing investors. So we see we see Celsius collapsing really under the pressure of the broad misallocation of capital within DeFi, where people were just trying to get yield, not really knowing where this yield was coming from.
Right. And you're referring to the fact that, your mom and pop investors were getting double digit APY that seemed to be fabricated out of nowhere. It seemed like a lot of these platforms were throwing cash at this. It wasn't real yield. And so you mentioned Celsius falling in tandem with 3AC for different but related reasons. And so my question becomes, is this a crisis specifically within the crypto lending market?
So I don't think that lending itself is the only issue here. I mean, if we look at the trigger to a lot of this collapse, which is this Terra Luna link, that's not a lending issue. That is a project that is trying to seek, you know, this is a project that's really trying to achieve something from it's trying to convince investors to allocate to something that isn't necessarily a good investment. So when people are allocating to Bitcoin or across cryptocurrencies and they're doing so without leverage, if they take a big loss, it will affect their portfolio. But if they're doing this with leverage, it can wipe out everything and more. So that's, you know, the function of leverage here is, I think, the main culprit. The lenders that lent to the players that were leveraging or trying to leverage returns, they are caught in the crossfire, but they're not actually at the beginning. They're just part of the mix of this collapse.
So how long are we in this crypto winter? It's been a rough few months, but are we looking at another multi-year protracted period of depressed prices?
I don't really believe so. So I want to bring it back to Bitcoin's correlation with equities. We've seen an incredibly strong correlation of Bitcoin to the stock market over the last year. And really, when you go back and look at the data all the way back to 2017, the correlation is very strong between Bitcoin and stocks. Now, you do have protracted periods of decoupling, and these happen usually when Bitcoin does its parabolic type of advances where it'll double or triple in the span of a few months. Obviously, stocks are not exhibiting that type of price action during that time. But most of the time, Bitcoin and stocks are ticking together, even though they have varying ranges of movement there in direction. I'm sorry, in terms of magnitude. So what do we see in a cycle? We see that stocks and risk assets generally bottom about half a year, a quarter to a half a year before a recession is over. And that usually corresponds with the Fed starting to signal that their tightening cycle is over. So, what do I believe? I believe that if we are in an economic contraction right now, which Atlanta GDP shows us that we've been in negative GDP growth for half a year, the Fed will eventually stop raising rates, I believe, sometime towards the end of this year. When that happens, the rate of change of monetary tightening starts to decline. Conditions start to become easier. Stocks will bottom and eventually go back up, and Bitcoin will be right there next to the equity market, ready to charge back up into positive territory as the Fed starts to ease monetary policy.
Okay, with that, you are all caught up for today, but Crypto World will be back again tomorrow, and we'll see you then.